All right, guys, we're moving right along. We're going to talk about the move, and we're going to fragment out a chart from a move to a retracement, strength and weakness, and I kind of put a quote down here. Is it the beginning of the end or the end of the beginning? We're not going to try to make sense of that. I just threw it in there to confuse you. But one thing I stumbled on and I wanted to make mention to anybody watching this video, and that is, what is the right answer? Meaning, what are you looking for? We're looking for stripping out randomness and trying to predict where price is going to go next. That's all we're doing. We're trying to figure out what the weather's going to be this afternoon if we're a meteorologist. So what are the tools? So they know what tools, they know what they're looking for. Cold fronts, where's the wind coming in from the north, it's going to be cold. They know where to find the end, and they got the right tools. They know the right answers they're looking for, I guess, and so they know the right questions to ask and therefore the right tools. But I guarantee you most people who, when they started this business, didn't know truly what they were looking for to get good at predicting price movement. They knew they wanted to buy it if it was going up and maybe sell it if they understood getting short if it was going to go down. But when does that happen, right? How do I know that? Order flow. Ooh, order flow. You see the footprint, all these numbers. Jigsaw's got some cool software, and you're like, yeah, I've been missing this. And there's some truth to that, but that's not the end all. And then you have red light, green light indicator stuff, and you don't know what you don't know. So that seems like hey, that's great. I don't have to learn anything. When it blinks green, I could buy it. Blinks red, I could sell it. Life is good. That the indicator's doing all the thinking. And then you come to the realization that's too good to be true, and it doesn't work. But that's, again, not your fault. The key is to, no matter where you're at in your level of experience and success, if the CME group, the almighty CME group, the biggest futures exchange in the world, came to you and they said, Bill, Bruce, Christine, Dale, Dave, Joe, John, Patrick, Nick, Paul, Ron, Stan, Tom, we're going to give you one slice of information that we have in our servers. We're going to walk you around this big plant in Aurora, which is honestly not too far from me. That's where their exchange really is. It's not the CME building in the city. When the floor was around, it was. So it's this big building, right, with servers. And they came to you and they said, what information do you want? We're going to give it to you, which if we give it to you, it's obviously real. It's not a delta, which is maybe an assumption of longs or shorts. It's not the way we maneuver these numbers around to show you aggressive buyer. What is it you want to know? And I'm not going to ask the question, go through it, because I want to start today's topic. But most people would get the answer wrong as to what they wouldn't know what they'd want to tell the exchange they'd want. They wouldn't know if the exchange came to me and told me, Anthony, what do you want? I'd say, give me everybody's real-time position. Okay, great. You want me to put it? How do you want me to put it? I said, well, I'll put it in a dial per product. You got it. We'd be able to trade with our elbows and our toes if I knew everybody's real-time position. Now, most people wouldn't understand that that's what they would ask for if the CME asked you that question. There's another answer. Stop. Give me where all the stop orders are. All right, no problem. There you go. Now, the CME has that information, right? They know everybody's position, and they know everybody's where stop orders are. The point I'm trying to make is those are the two things we're after, that information. CME isn't going to give it to us. But now you're in a better position to find the tools and understand how to read the tools to get to those answers. It's a probability thing. If the CME gave us that, it wouldn't be a probability thing. It would be a higher level of exactness. We'd still have to kind of know how to trade and everything else, but boy, that's the best indicator of all time. And the point I'm trying to make is every tool you try to understand from this day forward, in the past, in the present, in the future, all comes from understanding with how do I get myself in a position to know real-time positions of most of the rest of the market, where maybe there's a cluster of stops. What else? Orders that come in before they come in. Boy, that would be nice to know. Streaming these orders, but before they come in, that'd be more in the back. Tell me real-time positions. Give me an idea of where stops are. You don't even have to give me just that I know that they're there. There's no probability there then, right? And we try to do it with patterns, and we do it with tempo and edge zones, and it gets us closer there. Those are the tools because it gets us closer. But if you don't know what the answer would be if the CME group came to you, then you're going to have a tough time finding the tools. All right? You're going to have a tough time finding the tools. Hopefully that made sense. And I just came to this, it hit me by just talking through some things today in the trading room. So I hope that that helps. Because most people, maybe not most of you guys, but most of the people out there, and all of you guys when you started would get the answer wrong. They wouldn't know what the CME group came to you. Most people out there, including most of you when you started, would tell them an answer that was insignificant, or you would be like, well, let me get back to you. I mean, what do you mean, give me information? Could you pay for my charts for, how about free data? I don't have to pay $15 a month. Can I get free data? CME group, yeah, sure, if that's what you want. That's what most people would probably ask for. Free data. All right, let's get rolling with today's session. And we're getting good groups here. I mean, people are attending, and that makes me proud because I can't make you come here. If you work for me, I'd make you, but I can't. Most of you guys come. So the move is the title of today's session. Again, the beginning of the end or the end of the beginning. I don't even know what that means. I just put it in there so it makes you think and maybe confuses you. What we're going to talk about, and this is not going to be a super long one. I don't know how long they go. I don't time them out, but I build these out and makes me think through what we're going to talk about. The move is you have to start breaking down the chart quickly, and then you can't take your time. You got to know, bam, 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 and you start to create your own progression that way. Break down the chart into fragments. And I did something similar to this a long time ago, but I think this one will be even better. A couple questions we're going to answer. What is a move? What is a retracement or a pullback? Means the same thing, pullback, retracement. What are failures and how do we see them? And then why does sometimes higher highs mean a clean out? So higher highs generally mean, hey, we're going up. That's what you need for an uptrend. And that's true, but they sometimes can mean a clean out, so you got to be careful. And I'll tell you what that means as we go along. And I'm going to do some illustration and stuff like that. So let's go through these questions. I'm going to actually go back and forth. The way I'm doing this is I'm going to go back to this slide to draw, but this slide to ask and answer the question. So what are moves? Moves should be easy to understand. It's a distinguished start and end to a rally or break. All right? So in this case, let me pull up my pen. I don't want to spend a lot of time on it. A move is simply a distinguished start and an end to a move. It doesn't mean a straight line without pullbacks. It could look like that. It could look like, something like this. But and we'll show some real charts in a second. But just, hey, this market moved from here to here. You could, as you're getting better reading charts, and this is where everybody is going to be or should be, most people who start wouldn't understand it, but a move is just, it started down in here, it rallied, and it died out up there. That's a move. It moved from there to there. All right, that's a move. Next. A retracement, also a pullback. Different word, means the same thing. What is it? Definition, coming off or giving back some or all of the move. So if the move, this guy right in here, is this, the retracement is this. It could stop there, it could keep going and stop here, it can give the whole move, which was from there to there, 100% of it back. It retraced the whole move. And I'm not sounding condescending, but I didn't understand what a retracement was. When I first looked at a chart, it was a CQG chart back in 1999, and it was on the floor at the Chicago Board of Trade. And I'm holding the mouse, and it had the words RET would come up, and it would be RRET or something. It was like, in rat race came up. So it's a rat race. What does that mean? Rat race. Wait. Retracement. Then the word allowed me to understand. Here I am with my membership trading real money, and I didn't understand retracement. Retracement is simply just coming back and retracing the move. Some of it, all of it, pull back. That what's important is just understanding, is it a retracement of the move or is it a new move? All right, next question. What are failures? Hey, listen, you don't know if it's a failure. We're trying to create probabilities, but after the failure, at least you better know this is potentially a failure of this. That's all. That's all we're trying to figure out. This was a failure right in here, maybe of this. And you got to use the words maybe, probably, and things like that. We're trying to say, is this going to be a failure when it's up there? But we don't know it looks like that. Is it too late to say it when it's way down in here? Yeah, usually. But it's not always too late, at least to understand that that's what that is. Why is it a failure? Well, the market went up. It retraced 25%, had another chance to make what? Higher highs, and then it didn't. So that's what failures are. And the reason why failures are important to distinguish is because most people who are wrong for a long time, right? And that's the weakness of many of us if we're not trading well. It's not that we're wrong. It's that when we are wrong, we're wrong for a lot of money and for a long period of time. And so when there's a failure, that means longs, in this case, thinking it was going to go up. It didn't, so they're trapped, and it continues to be a downside is the right side and a reversal. Generally, you need a failure to get a good reversal. You need to suck more people in. But that's what a failure looks like on the upside. On the downside, it would look like this, right? High or low. That low is higher than that low. So what did it fail doing? Failed making lower lows. Well, guess what? The trend is your friend for all these other clown traders, but the trend is not your friend. Remember, the trend is not your friend. In fact, that's the title of the talk I'm giving in New York on March 9th. If you're in New York, come and see me. March 9th, right on the Brooklyn Bridge, I think on the other side of it. The trend is not your friend, because generally when you see it, it's too late, and you usually buy it and it does that, or sell it rather. It's a downtrend, right? Beautiful lower lows and lower highs. It's looking nice, but it's a failure, and then it runs. And generally people, when they see a trend, then they get short, and it's the end of it. You're the retail. You know what I mean? You're the retail. So that's why it's important to recognize failures while they're happening, but at least after they become distinguishable. We're going to talk about that, Ron. Question is, when does a retracement become its own move? We're going to talk about that. And it's not a exact scientific answer. Like every time this happens, it becomes a move, but it's all about probabilities, right? And by the way, if the CME group came to you and says, what do you want? I'll give you any information. And you said, tell me when a retracement is a move. They'd say, what the hell are you talking about? We don't know that. They didn't want to have data on that. I'm not saying that that's what you would ask, but the point is that it's all about probabilities. And we'll get into it in a second. Now, next question. I actually didn't read out the definition, but again, failures are distinguished lower highs or higher lows. Let me draw it again. So lower highs or higher lows. And I'm not trying to be too simplistic, but in order to understand this, I am. Crooked M's, crooked W's, you could also look at it that way. All right. Next, why do sometimes higher highs, wait, let me read it like I wrote it. Why do some higher highs sometimes ... Sometimes what? This is when it's most important to watch the what's next. And that is a false, let me just do, instead of going back to the other chart, let me just draw it up here. When do some higher highs not show the continuation? Like I just walked through and said, this is a failure, right, of a high. And that's, after the fact, fails to go up, doesn't make a higher high. But let's say it passed the test and it actually makes a higher high. Do you just rub your hands together and think life is good and markets are going to rally? Maybe, but you got to be careful that it's not a clean out. What do I mean by a clean out? What I mean by a clean out is you get everybody who is short, okay? stopped out. Where do most people put, let me draw this again. When you have, especially at a couple swing highs, where do most people put their buy stop? Above a swing high or a couple swing highs, right? If it makes a higher high, it's not always, oh, it passed the test. Here we go. Let's go. Let's go. Up, 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 and away. If it kicks back real quick, all it did was squeeze out weak shorts. They puked above those highs, and it came back, and now it's got less support below because all these buy orders got canceled because all the buy stops got triggered. All the buy orders got canceled because all the buy stops got triggered. And let's just look at as I remove the X's, all those buy orders get removed. It's easier for price to go through it because there's nothing to go through. So that's when you got to be careful and start saying, what's next? If we jump right back into underneath where those highs are, this could have just been a clean out of buy stops. Shake out weak shorts. Shake out weak shorts. Now's the time to go lower. That's the whole point of looking over your shoulder and saying, all right, I want to be short now because most of the shorts probably got shook out, and understanding this pattern in this way. So the market moves up, and it's not a retracement anymore of the move. It's a new one because it just cleaned out weak shorts. Weak shorts always use, well, not weak shorts, shorts, period, use buy stops to cover their position, correct? And where do they put their buy stops? Above, easy highs to read and things like that. So when they kick right back in, and it's in a form of head fake, right? But that's when you have to be careful and not just think your higher highs mean continuation. That's when you get people that get stuck thinking life is good and up, up, and we go. Not always the case. So what's important now is, hold on. No, that was last week. I didn't fill this in for this week. Let's go back a second. I'm going to go to real charts to talk about when a move becomes, when a retracement rather becomes a move, because that's what's important. And I could illustrate like crazy, but I think that we got to look at what we're going to be looking at to glean all this stuff. So let me remove this and pull out today's chart. All right. What I learned is when the owner of the firm said early on in my career, if the market moved up and within minutes or not a lot of time, the whole damn move was taken back, how strong was this move, right? You question the strength of that move if it didn't take long to take back the entire move. Most people do what? Just think about what most people do all the time. Most people see the move and then will try to buy a pullback. And if it works, great. But when it doesn't work, you generally have trapped enough people. That's the long up down bar. But you take back the whole move. One of the reasons why it's got a chance to now go from strong to weak is because you trapped some longs trying to buy it on the way down because they weren't bullish until they see it run up. But the other thing is the fact that whatever got us to go up was BS. It was stupid news, as Brad articulates in the sessions him and Brett have done in their podcast. Whatever it was chicken, S-H-I-T. It was something to get price expensive. What helps perpetuate it to the downside are trapping longs. But if it retraces the entire move, you got to question the continuation of that move. This move is strong. Why? Because the move is up. It's a rally. If the whole thing is retraced, you got to question the continuation, which would be this dotted line. Now, the retracement has probably become a new move. I'm not trying to oversimplify it either. If this is the move and it's getting retraced, oh, that's good. It's getting, oh, that's good. It's getting retraced, oh, that's good. What? Holy shit. The whole damn thing is retraced. That's what happened to the unemployment number on Friday. So this move, don't think that every move is going to get retraced and going to go back up, retrace a little bit and go back up. That never happens. I mean, I shouldn't say it never happens. Nothing happens all the time. So a move could never be retraced and have continuation. And so just remember this. If there's a move and a retracement, then there's the thought of continuation. So if you didn't catch the price from this X to here, you're looking to buy a pullback at some point because you don't want to buy it too late in order to catch the continuation or the next wave, however, whatever word you want to use. And why do markets retrace? That was the one thing I wanted to add. I thought it was on the other slide. Why? There'll always be the question why. Let me spell that better. Markets retrace. Because people, this was the epiphany I had. Around the same time, the owner of the prop firm said to me, if this rally was so great, why did it get completely retraced in 10 minutes? I had a moment within the first 2 weeks. I literally remember this, where I'm looking at a chart similar to this, and I'm looking at the rally, and I'm thinking, the market goes up. Why does it go down? Market goes up. Why does it go down? Market goes up. Why does it go down? Why might it be advantageous to fade a rally? Why would it work? Why would price go down? I'm running through these questions in my head, and it just hit me because the people who did buy it that helped it go up are now selling it that are helping it go down. And then the people who are trying to buy it that can't get it and are chasing it, because that's why price goes up, right? At some point, buyers got to chase a move that goes up. That's why it goes up. At some point, it gets exhausted because they're all in. Everybody who needed to buy it did buy it, and therefore there's less buyers. And then the ones who, want to take profit or get out of a long position, they're the sellers that create the pullback. Now, the pullback could be 25%. It could be 100, 50%. It could be 100%. But I had that moment, and that's where the whole after you buy it, you're a seller comes from. But I had that moment of what makes price fadeable. You have to know why stuff works in order to get confident to do it, or else it just feels like a good guess and it becomes and stays random. You have to know why it might work. You have to know why price goes from strong to weak, from strong to not as strong. That's what a retracement is. It's strong. Well, it's not as strong, but it's going to get strong again once we could find the fact that there's no more people trying to sell it and we could rally again. Because that's why there's a pullback. The other end of it is people who bought it to get it to go up are now selling it to take some profit. And you're also getting people who are trying to do what? Fade it and sell it. They're chasing it down. When they sold it and they turn enough into buyers and they start to move it back up, and the buyers who bought it down here already sold it, you got less sellers, you got more buyers, and then there's the continuation. The health of a move has a lot to do with how much it got retraced. 2 words I want you to talk about, to remember. Shallow and deep. Use these words in questions you're going to ask. How shallow or how deep was the retracement? It's pretty deep if the entire move gets retraced. That's a deep pullback. And now it's no longer a pullback. It's probably a new move. That's a deep pullback. So in my analysis that I do in the room, and it's second nature, and I want it to become second nature to everybody, I'm automatically knowing how deep or shallow a pullback was to get an idea if the continuation will have a deeper reach, a longer reach. For instance, you hear me say all the time, it's going to be hard for the market to rally. Why? The retracement's too deep. Too many jerks that got long in here are stuck, and now they're all baby birds probably going to try to sell it. It doesn't mean we can't go up. It just means it's going to be harder to go up. And sometimes so hard to go up that we go down. So hard to go up that we go down. So when you get a deep retracement, it doesn't have to be the entire move, but it could be 80% of the move. Now, when you get a shallow retracement, we don't know this is the bottom of the retracement, right? We don't know that. And again, the CME doesn't even know that. All right. But what we do know is if it jumps and starts attacking the high, and we look back and we say, wow, you got to be careful if you're short because this thing has a lot of upside potential. Why? Because the retracement of the move was this X to this X, was shallow. Well, why would that make the continuation more powerful? Because a lot of longs weren't allowed to get in, therefore they're not sellers. And a lot of shorts that are stuck selling it from wherever weren't allowed to get out. They're baby birds that are still hungry. They're not satisfied. They didn't get fed. Price didn't come down to let shorts off the hook. Does that make sense? That's why a shallow retracement, if indeed it's shallow and didn't go down, it has a much better upside potential because you didn't give shorts a chance to get out. And if you didn't give shorts a chance to get out, there's still buyers. If you still have a lot of buyers, you still have a better chance at stronger and higher prices. So remember those two words, depth or deep and shallow. And you're asking and answering these questions so fast that it becomes second nature. That's when learning turns to understanding. And that's the whole point of this coaching session and repetition. That's the other thing I stumbled on, not today, but a while ago, that repetition isn't redundant, it's necessary. And Dave made a good point where pilot's checklist or it's not, it's supposed to be so boring that when something's out of place, it becomes so obvious. So redundancy and repetition are absolutely necessary so that you don't have to think about, well, wait a second, be careful because this retracement was shallow. You don't even have to go back and I missed that. No, you're understanding it. It's the repetition of going over this stuff and over it and over it and over it. And so we're going to pull moves out. Like I said, a move is a distinguished start and an end to it. And transitional moments are when, like Ron's question, when a retracement rather becomes the new move. So here's the move, here's the retracement. It's a healthy retracement, and there's could be the continuation. And it's not going to look perfect, but the continuation is it takes out that high and the strength is intact. That's a healthy move. Now, if the retracement becomes too deep, it's harder to rally based on the things that we talk about, and you know. And it also could be a transitional moment or B to B, bullish to bearish in this case. And now you look and say, wait a second, this now becomes, instead of a retracement, the new move, and maybe that's going to get retraced. Does that make sense? See how you're fragmenting this stuff out and based on moves and retracements, and that's it. Moves and retracements. Consolidation boxes, but you know that. Moves and retracements. And no market stays in a straight line and just does this all day. It chops sideways, and we know that. But the point is, up, hey, there's a strong move. It's still strong. Wait a second. It ain't that strong. Oh, boy. How strong is it? And then there's the retracement and then the continuation of strength to weakness. This is obviously strong because it rallied. This would have been strong had it stopped there or stopped there, stopped there. But at some point, it got weak. It's no longer a retracement. It becomes the new move. And this becomes a retracement of what? Of this. Am I making sense so far? Moves, retracements. Hopefully this is obvious to some people, and hopefully it's not obvious to others. And there could be a mix. Hopefully it is a, again, it's like you want it to be back of your hand in second nature so you could identify it quicker to help you get off the wrong side first. All right, so when you look for B2B moments, all right, which trying to confirm in a little better way, not a better way, but sooner rather than later a turn. So the market turned, we know it turned up here. I got to move this out of the way. We know the market at this point turned up here because we know all this information. Well, that's easy. It's not necessarily easy, but it's obviously hindsight. What could we have found early on that the down move, the moves lower are no longer retracement, they're moves. I say it again. In an up move, the moves lower are retracements. But after a turn, the move lower are no longer retracements, they're new moves that could be retraced. So you got down up bar, which that should continue the bullishness, and it tries to, and it tries to. And then once it gets through this green, at some point in here, I wasn't watching intently to know that there was something in here that would have told me to tell you guys, hey, this is going to go down. There might have been, but I wasn't paying attention. I was paying attention and said, halfway through this bar, hey, this is no longer a retracement anymore of this up move because it was retraced a little bit there. It was retraced there. It was retraced there. This is starting to become a new move, and this is probable. So this doesn't feel like a good guess. This isn't hindsight's 2020. This is what you envision the chart could look like based on walking through, hey, this was the move. They already had retraced it like 3 times. Maybe they failed, but they come down fast, and knowing all these things help you predict that this is no longer, like, moves lower are no longer retracement, they're actual moves, and they're getting retraced. Here's a move, they're getting retraced. Here's a move, it's getting retraced. Here's a move, it's getting retraced. Long up down bar, bearish, it gets retraced. Shallow retracement. Shallow retracement creates more downside. Take a look at this. You can really break this down. This is a move from there to there, right? This is a shallow retracement. You don't know it at the time. Damn it, it could go up here. But you're starting to say, wait a second, as it's getting through this green, if this indeed was the retracement, this has got some really nice downside. Be careful. It's not random anymore because the retracement was shallow. They didn't give a lot of people who were stuck long a chance to get out because it only went up to there. You can start saying that down in here. And when it's a day that's moving, you're getting more people stuck long and short. You're getting follow through. Now, you could dig down, but don't get too deep into it. I talked about yesterday taking, you don't have to go from when you're looking at different time frames, all right, you don't necessarily have to go from a 5-minute to a 60-minute to increase your time frame. You could increase the look at the move, right? The step back and say, all right, this was a move that I could distinguish to here, but I also could distinguish the son of a gun all the way up to there, right? And you could say, this move here was retraced with those guys right there. This move here, it's still healthy, retraced there. So on this time frame, it's still kind of bullish. But you better not be putting your short ass time frame trades on something that is an hour of a move. You could keep it into perspective, but you have to say, hey, what also happened on the shorter stuff from here to here, the whole damn thing was not only retraced, but they've already retraced some of this move up. You just got to be careful because you're reading it in the smaller time frame. And so this is the way I'm trying to help you guys understand it. This wider circle is what has it done over the last hour? What has it done over the last half hour? What has it done in this time frame, like over the last 10 minutes? And I don't think there's too many people that would look at this, how fast it moved down in here, once you kind of understand how to read charts, that would say that this time frame is still bullish. So you see how you get all these time frames with all this confliction, and that's why you're getting people who are bullish when you're bearish. And neither of you might not be wrong, but it all has to go on the time frame you're using. So if you're going to play this, if you're going to play that this is the retracement of this move up, right? Well, you better have the personality to stay in the trades longer. And then you want to be able to disqualify staying in trades longer that don't work, based on saying, you know what, yeah, this time frame is pretty damn bullish, but everything since then is pretty damn bearish, including some information that came down. And now you're starting to tie in, like there was a Trump tweet that was negative towards Powell, and then there was something that I didn't see was too negative, but negative comment from the CDC. So you knowing your time frames without overthinking it, but also understanding, are we in a move or a retracement on that time frame I'm looking at? Let's start from this morning. There's a move. I mean, the start of this move afterwards, before this bar, because this is something that I walked people through. We were weak all the way in here. So the market goes down from here to here, and this is a retracement of this move, right? It does what it's supposed to, goes down. This move from there to there gets retraced here. This move gets retraced a little bit there. This move gets retraced a little bit there. All of a sudden, we don't know it can't go down. It can keep going down forever, and life is good. But at some point, when the SOB rallies hard through a level or two, at some point in this bar, and I remember saying it, this is no longer retracement. This seems like it could be a new move. When an old retracement turns into a new move, is what's going to help you with your B2B transitional moments. When what was retracements turn into a new move, now that gets retraced. And you see how shallow this retracement was? And now it turns into what? The old-fashioned box. We talked about how the middle was important. We had news. That was the highlight of today's video that called this move. And then you get the grind because it never just comes off. It never allows shorts to get out. The people who cannot get out of losing short trades, especially guys that get short good up here, they see all this profit. They see all this profit go away. So they're like, well, I'll just, next time it goes down there, I'm going to get out this time. And they just can't get out anymore. It doesn't let them out. And then usually most of them get out, most shorts get out, and now it's able to go back down. And the same guy, and this happens, I'm telling you, this happens more than you'd like to know. Someone's short from here, when they make a good trade and they get short in a good position and they got all this profit and they don't take it and all of it's chewed up with this bounce, what do you think they say? Next time it gets down here, I'm getting out. It doesn't go back there. It goes up, doesn't allow them out. Goes up, doesn't allow them out. And then they just puke it. And then it goes right down to where they would have got out for the winner. I finally get squeezed, and then it goes, is what they say. And this isn't an extreme example either. Just get better at transitioning from when a move gets retraced, and now when the retracement is not, and it's becomes a new move. The old retracements become potentially a new move, and that's going to get retraced. But keep in mind that they don't get retraced beautifully like this. Sometimes they get retraced. Let me clear this. Sometimes they get retraced like this. Point in case, this move. It got retraced with a lot of chop. And your ass and my ass could get chopped up trying to buy it, and then it goes and we're not long. That's going to happen sometimes. So it rallies, it goes sideways, it needed a reason and some imbalance in order to continue. And then once it continued in here, and we were saying this is a grind that there's no, just got to be careful trying to get short. It's not giving shorts a chance to get out. I could say that in here. This retracement sucked. If you're a short, that's a terrible retracement to allow shorts out. You could say that right here because the retracements were shallow. So those are the questions you could ask yourself. When you look back, is it a move? Yeah. Was it retraced? Yes. Was it deep or shallow? Shallow. It'll help play out the probabilities. And again, do everything you can to strip randomness out. That's what helped me, with this topic over the last couple of weeks. The interview I actually did with Anthony Crudelli, I actually did a couple of weeks ago. And, the word randomness just naturally came to mind about how I transitioned from not making a dime in the pit to doing just 180 degrees different when I went to the screen. And it was because I removed the word randomness out. You're not going to make any money or be consistent at anything if it's random to you. It's not going to look right even when it goes together. If building a deck as a carpenter is random, you might hodgepodge something together, but it ain't safe and ain't going to look right. So you might hodgepodge some profits together in a month, but you just got lucky. You got away with some bad stuff. You cut the wood too short, but it was just, long enough. The screw caught. You're able to do this. It's just you could tell when you should be able to tell when you look at your trading if it's just a hodgepodge and you got lucky and it looks like a pretty crappy deck, or this thing is pretty solid. This was a solid week. Sometimes you can have less profits, but a more solid week based on your read and your entries and your risk management. Your articulation through the trade, through the process. Anybody with Sierra and Ninja has to have this verbal journal. People I've been working with that have it, they're just getting off their chest stuff, documenting good stuff, keeping a record of it, but articulating, like Ken said 2 months ago, if you can't articulate it, it does not exist, right? So the move defined, retracement defined. Now your job, our job as traders, is to continue to define what it is. What it is. This is a move from there to there. Shallow retracement, continuation. All of a sudden, this jump, you don't have to wait to see that the market's sideways. You guys know how to read a chart that this jump probably is going to create a tougher time to continue down. Doesn't mean it doesn't go down. It's just tougher. And overall, it's just sideways because of this jump. Doesn't work all the time. Here's a big jump. But guess what? That jump came into resistance. And then this became not a retracement, became a new move. And at least you know that up here, instead of down here, that this jump didn't transition us back north for very long. This jump, hey, maybe it's bullish. Right now it's not. And you know it in here instead of, again, down in here. So at least you're not trying to maybe buy it just because you've seen rejection. How often does that happen where something happens that qualifies a trade, but if you remained objective, you'd have got the hell out of the trade because whatever qualified the bullishness took it back? Like the owner of my firm, if it was so strong, why did it get retraced right away? And it would be okay to get long because it qualified some rejection, but you didn't recognize that it now disqualified the rejection. And yet, because you're not objective, because you're long, you take a bigger loser than you would or add it to it because you were bullish when you seen this, but you didn't get bearish in time to get the hell out, to keep you off the wrong side. Because this became, let me open this up. This became, right in here, a new move, not a retracement of this anymore. And this move got retraced shallow, and you don't know it's shallow in here. I always go over this with people that things are always easier after you see them. You always got to put yourself in a position in real time. We don't know that this is a shallow retracement, but you begin to see that once it's down in here. How far did this move get retraced? Not a lot. Well, if it didn't get retraced a lot, who struggled to get out? Longs. If longs struggle to get out and there's more still in the market, that means there's some more sellers than if this retracement went higher. And that's how you begin to fragment out a chart and read the damn thing. This is reading a chart, by the way. And so everything gets retraced. All these moves get retraced until where? In here. And is there any coincidence that the downside stopped becoming the right side after this? No, because this became the move that was retraced. And it's type of day, which sucks. I mean, time of day, which starts to stink, right? And the market should have rallied, doesn't. It's got too many longs, so it has to do this. And what is this? Chop. Can you, without randomness, predict that this was going to be chop, and it has been, and you're not surprised? Is it coincidence because now you're looking at consolidation boxes in the middle of it? It's not a coincidence that the market stops there and there. Then when it gets through it, it's no longer as bearish. It might be a little sideways to up, and it kind of is or was. And now that there's buy stops above there, now we're looking at, wait a second, let's take a step out. If this is a move from there to there, this is a retracement of this, right? And that's only about 50%. Maybe that's why it's tough to get through. You're damn well right that's why it's tough to get through. You start to strip more and more randomness. That's why it's chopped from there, because you have people that are selling the retracement from here to here. But once they're wrong, they're going to chase it up, and it's going to totally take back this pullback. But way back in here, when I say way back in here, you begin to see that this was probably the next right side of the market, not the continuation down. Why? Because you had quick rejection. And now the retracements became the move. Fibonacci is, if you think about Fibonacci, that's what Fibonacci is all about. It's just identifying the move and seeing how much it retraced. That's one way that Fibonacci is maybe not bad to use. It gives you a sense of, like the owner used to throw fib numbers on moves, not to trade them, just to get an idea of the health of the retracement. But we're not, we weren't 382, 618, and 50% animals. We just use those as like, oh, okay, it's, went down and only retraced about 60% of the move. Still could be healthy to go down. Once you start getting above 70% or whatever, let's start retrace too much of it. So if we had like a meter of a move and you said this was a move from there to there, what's the health of the retracement? Well, it's only about 20%. That's pretty good. So when you get a 20% retracement, that's shallow. When you get 50%, that's normal. When you get 70% or greater, and these are just my opinions now, it starts to become too deep. And it's harder to go back down. So if this is let's put these numbers here, 70%, 50%, 20%, and the market's moved here, 20% retracement would be there, 50% would be there, 70% would be there. It starts to question the weakness of this move and becomes a deeper retracement than you'd want if you were short. You want a move to, especially if you're short, you want the downside to barely retrace. Keep those longs stuck. So you got to take this session and work on it. Like Warren said, this is really great. It's actually what he's been thinking and working on. And he's a big verbal journal proponent. He's using it to in fact, I want to do a session in how tightly correlated in the power in not only the rest he was getting and how it was affecting his trading, but how documenting his rest allowed him to get better rest. And that's one of the Tuesday sessions that I have up on the whiteboard now I want to do, to document. I think that there's some simple things that a lot of people are missing: routine and sleep. It's a mental game. So if you're tired, it's, it's not so much. Here's the thing, and I'll say this, I don't want to steal too much thunder from a future session, but when you're tired, it's not necessarily that you'll make a bad decision. It's that if you make a bad decision, you're more inclined to make another bad decision or deal with that bad decision worse. So it's not like, well, I make great decisions when I'm, tired. Maybe you don't make bad decisions when you're tired. You just don't react as good to them or clearly. It's going to be harder to get objective if you're tired. So it's not about, well, if I'm alert, I make better decisions. No, you just handle bad decisions better. That's what's important. That's what's important. When you're tired, you are going to handle things worse. Think of a kid crying. He's tired. So if you want to be a crybaby, then be tired, and you'll handle bad decisions worse, and they'll become doubled and tripled, and next thing you know, you had your big worse ass day. And if you were more alert, you wouldn't have had that second trade because you would have reacted better. Reaction. Sheriff Tom, how important is good objective reaction when the SHIT hits the storm in a confrontation, right? Lots of at stake when you're on patrol. And what we're doing in this business is constantly on patrol. We're trying to see where other people are stuck and where they're going to cry, complain, get mad, get angry, and we're trying to take advantage of that. But by protecting our own position and own emotion and own objectivity while trying to take advantage of others. Now, Tom and law enforcement don't take advantage of others. They're trying to protect others. What we're trying to do is protect our capital and our well-being by, I think, hunting deer is a better analogy. If you think about hunting deer, all the time and effort and work goes in before you pull the trigger, correct? Pulling the trigger is important. But after you shoot, it's over. You killed it or you didn't, and things gone. But the prep, your gun's clean, you loaded it, you're quiet, dressed right, sitting in that deer stand, whatever. A lot more prep to get the shot. So the prep is reading the market, being patient, get the deer, take the shot. You missed it, there'll be another deer. But sometimes when you trade and you miss the deer or take a loser, all of a sudden you're chasing the deer down in the woods, shooting like crazy. Bam, 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 bam. It's just like, hey, wait, relax. You're going to miss the deer. That's a losing trade. There's no problem with that. Reset. If you're alert and you slept well, you're going to react better, period. Now, what kind of questions do we have? I think this has been a helpful webinar. Someone says it knocked something loose. Helped away thinking pullbacks in my time frame, shallow, deep. All right, great. Well, that's the whole point of coaching sessions. There's always a better way to see the same thing, explain the same thing. Great analogies, different people saying it knocks different things loose at different times for different people. Just remember what I said at the beginning. Do you remember that story I told, Kim? Kim says never traded on a hangover. I lost 83, something in the 8,000 handle. At the time, it was my worst day. And it was because I didn't make bad decisions. I reacted poorly to bad decisions. That's the best way I could explain it. And I was 26, 27 years old last time I did it. But that's a perfect example. When you're hungover, you're what? You're tired. I wasn't drunk. I was tired. So you might not be hungover, but you could be close to it and not realize it. You've got to document if you're sleeping well. I think most people don't sleep well, and this is not the right job. Would you want your surgeon to be tired? No. Well, pretend you're your own surgeon. You are. You're surgically trying to duplicate your money, but in doing so, you could lose it. So don't be tired. And if you are, at least recognize it. I mean, there's kind of a lot I said. That's why it's recorded. Go back over and play it. And then, think if this is part of like the work. It's like, well, you could go crazy in saying, well, how about the retracement here to there? This is not that bad. I'm going to sell it. Fine, but your ass better be prepared to take heat, not call it heat, because you're trading a different time frame. The larger the time frame you trade, the longer you're going to hold on to your trades. The longer you hold on to your trades, the bigger rewards you should look for. And the bigger rewards you look for, the bigger risk you have to take. But it all should be relative. As long as you have that expectation, you limit and minimize surprises. But do you see why this rallied? And it's not a surprise as we're talking through it. When it got through the middle of this box, did it go fast? Yes. Was it a surprise that there were buy stops above here? Of course not. This should not make you feel, why did that happen? We all know why it happened. We talked about it as we're going through it. Or buy stops above here, shorts are chasing. This was a pop. This was a retracement. The last move was bullish. The last move was bullish. It's another way you guys could focus on, all right, is it a retracement or a move? What's the last move? The last move was bullish from here to here. Bunch of moves ago was bearish from here to here on a different time frame, correct? The last move was bullish from here to here. This is a retracement. Well, how do you know when it turns? Well, when you get a move that, a retracement that's too deep from the last move you're talking about. Now, guess what? This is a move. We're all trying to predict the chart by reading a chart. And remember how I started this coaching session. Remember how I started it. If the CME group came to you and said, what piece of data would you like? Give you anything you want. It's like Genie. Give you anything you want. Most people would ask for the wrong stuff, or they wouldn't know what to ask for. It's all important to be trained and always put yourself in a position to react better to bad decisions. Well, hold on. Hey, Roger, I'll send you a chat. Any other questions? Wait, I got a question. I didn't see it. So do I think on the wait, where is this? Do you think on the retracements you're watching for faders to get stuck, therefore watch them puke when they get a shallow pullback? All right. So let me draw this out so I understand the question. When you think on retracements, you're watching for faders to get stuck. All right. So the market moves up. You already have probably people who were selling it all the way up, but you always got people that are fading it. And so you could assume they're already stuck. All right. What's key is, and if you think about this for a second, and I'm glad you asked this question, this is one thing I wanted to explain. Even though it's a retracement of this move, right? This is the retracement. You are still a fader if you're looking to buy a retracement. A fader is someone that is, let me draw a picture of a person. He's looking up. Something's coming down and he's looking to buy it. Here's the move up. There's the retracement. He's looking to buy it. You're fading the retracement. Okay. There are also people fading the move. You're fading something coming at you. That's a fader. But you could fade a retracement. Now, to Dorian's question, if I'm looking to play it, and this is the best way I can answer the question, is if I'm looking to play this move from the long side, which means I'm looking for a breakout or a retracement to find at the bottom of that retracement selling that can't get price to go down anymore, which is showing that faders are maybe fading it down in here or selling it. They're not getting paid. They're stuck. Doesn't make people happy that might have faded it there. You know, you have people fading this move all the way up. How much? I don't know that. But any move up, you're going to have people fading it. And so if you could get, if it's a move that's strong and you think it could be you don't want to wait too long because it's a strong move. You don't think the retracement's going to be too deep and you see selling coming in, that's you take a shot, pull the trigger moment. Yes. But what you want is you don't want to screw around too long to go up. Shallow retracement, if it's going to stay a shallow retracement, shouldn't take long to follow through. But always looking for rally. If I'm looking to play from the long side, you should always say that. It always helps me to say, hey, what are you trying to do here? I'm trying to play this from the long side. You should have your reason. I'm trying to play this from the long side. All right, so here's a pullback. Selling coming in, can't go down. And you're trying to predict this move up. Selling come in, can't go down. NASDAQ pops, right? Couple things that then overlap to pull the trigger. But you're already looking to play it from the long side, Dorian, and you're looking for your qualifier on a pullback. And if you get it and it skips up, now you know, hey, wait a second, strong move, shallow retracement, shouldn't take a long time to go up. That's when people say, oh, you got good intuition. It's not intuition, it's the experience and the training of knowing that it should do something based on what I just walked you through. Does that make sense? It should do. People think it's intuitive. It's not. It's not a discretion. It's strong move, maybe stuck shorts. It would have been a shallow retracement, so it should rally. And if it does this and you get some stuck shorts right there, or stuck selling, it's not heavy shorts, it's just selling doesn't get to go down right. And then it starts to go up and you got a little bit of a head start and you got the NASDAQ that's just jumping and the Dow maybe jumping and we're not. It's not intuition. It's, you know what? This market's not ready to go. And there'll be times where you're thinking you're buying the retracement. You're just buying really the next move. All right, I'm going to stop the recording. My eyes fixate real quick, though, right on here. There's a reason why it stopped there. And I would have said it's probably going to stop there once I see this. This, by the way, and then we'll leave. This is the move up. These are the retracements. You don't want it to come much further than this for two reasons. Number one, that's about 50% of this move. And number two, you don't want it to dig deep into this chop. You want to keep these a-holes that are short stuck. And if you're short, I'm not calling you an a-hole, but you got to think of the other side being the enemy. You want those goofs to be stuck, stay stuck short. Stuck shorts mean more buyers, better chance to go up. That's if you're long.